4 lines. There's the overbought and oversold lines, the slow stochastic or %K, and the fast stochastic known as the %D, which is simply a 3-period moving average of the %K. So okay, let's not make this any more confusing. What I am saying is that there are 2 lines that move on this indicator, and depending on where these 2 lines are, traders can determine based on recent momentum whether the current security is overbought, and what this means is that the next move that is coming is probably down, or if the security is oversold. This would mean that the next move is likely up. So here's why range-bound indicators are very useful. They're useful because they have defined floors and ceilings. Okay? So that's illustrated here. And what this means is that the indicators cannot go below 0 and they cannot go above 100. So what the floor and the ceiling do is they help us to define and quantify whether or not a move is overbought, meaning that the price is too high, by looking at the proximity to the ceiling as illustrated here by the yellow line. But really this could be anything over 80. And it can also help us by seeing if something is oversold. So we see if something's oversold based on its proximity to 0, but really this could be anything less than 20. So anything less than 20 on the floor would be considered oversold. So other indicators can seem to go on forever in one direction, and the price action itself is an example of something that's not range bound. So if we just look at this price action itself, it can be really difficult to determine if it's high or low. So looking at this example, is this high or low? Well, you have to ask the question, high or low relative to what? And this is exactly why the stochastic is helpful. A really quick note, just because the stochastic hits a value of 100 or a value of 0 does not mean that the price cannot continue to go in that direction. This can and often does happen, but if you combine the information from the indicator and use the method that I'll outline next, the stochastic can give any trader a really large advantage. So let's go over a trading strategy for trends. If we use this indicator as a signal in the direction of a trend, we can minimize these false signals, and this is exactly what I mean. Let's use the stochastic to notate highs and lows in the price. So this is how we will do that. Here is a low, and then here is a higher low. Alright? So what this can allow us to do is determine the trend. So this would be an uptrend. And so what we can do once we have determined the trend is we can only choose to trade in the direction of the predetermined trend. So in this example, we have already determined the trend. And by looking at this as a series of higher highs, we now know, since there's an uptrend, we're looking for a trade to the upside. So next we'll wait on the indicator to fall to an area of 20 or lower, while the price stays higher than the previous low, keeping our trend intact. And this indicates that we're likely to put in another higher low after the price moves higher. So what we would do here is we would find our entry, and next we would expect the price to move up. And we would exit only when the stochastic arrived back at a level that was above 80. We would expect the move to move, that is, until the stochastics got to a level that is overbought. So the other way to use this indicator is by using it as a counter trend indicator. To do this, we will look at divergences. This is really similar to how we identified divergences on the MACD, which was covered in a previous video, and I'll put a link to that video at the end of this video. So here's what we are looking for in identifying a divergence in the stochastics. First, we want to identify the trend just as we did previously. For the sake of time, I will just go ahead and tell you that this is an uptrend as noted here. Next, we'll look for the price to put in a new high relative to the most recent high. That is shown here by these yellow circles. And notice how the price is higher than the previous price the last time the oscillator was overbought. That's what we're looking for. And next, what we want to see is that the stochastic is not putting in a new high relative to its previous high. That can be seen here. Notice that the price is putting in a new high, but the stochastic is unable to put in a new high. It's actually lower than its previous high. And so, in essence, the indicator is disagreeing with the price. The price is putting in a new high, and the indicator is unable to do so. Then, as the oscillator turns down, or we can also use the MACD to give us a signal, the stochastic, we would still want to see lower than the previous stochastic at this point. Only here would we have a divergence, and this can be used as a counter trend entry. We would then expect the trade to continue until the price reaches a level of being oversold once again. Hey, I hope you enjoyed this video today. Hit that like button. Please make sure that you subscribe so that you will never ever miss any of our future content. Thank you.